There's a retired school teacher in Ohio, 67 years old, 31 years in the classroom, good pension, no debt, a modest IRA she never touched during her working years. She did everything the way she was supposed to. Then one January, her Medicare premium showed up higher than it had the month before. Not a little higher, $95.70 higher, every single month. She called Medicare. They confirmed the number. She called her accountant. He pulled up her 2024 tax return, the one they'd filed together 14 months earlier, and found it in about 90 seconds. That year, she had converted a portion of her traditional IRA to a Roth, a standard planning move. Smart even. But the conversion had pushed her modified adjusted gross income $1,000 over a threshold she had never heard of. $1,000. And because she crossed that line, Medicare automatically added a surcharge to her Part B and Part D premiums, the full surcharge for the entire year, with no phase-in, no warning, no way to undo it. The extra $1,000 she earned that year cost her $1,148 in Medicare premiums. By the time she found out, the tax year was closed. The income was already counted. The decision was 2 years old. There is a rule inside Medicare that most retirees have never been warned about. It doesn't care whether you knew it existed. It doesn't care whether your accountant caught it. If your income crosses one of 5 thresholds, by any amount, including $1, the full surcharge for that tier locks in automatically. And because it's calculated from your tax return 2 years back, most people find out after the window to do anything about it has already closed. That rule is what this video is about. And by the end of it, you'll know exactly how it works, what income events are most likely to trigger it, and the one legal mechanism that can reverse it, if you move fast enough. Quick note before we get into it. I'm not a financial advisor, a CPA, or your personal planner, and nothing in this video is personal advice. This is the briefing, the thing that helps you walk into that office with the right questions already in hand. If you find it useful, hit the like button now. It tells the platform this kind of content is worth putting in front of more people, and it takes about half a second. Let's start with what this surcharge actually is. What IRMAA is, and why nobody talks about it. It's called IRMAA, Income-Related Monthly Adjustment Amount. That's the official name, and you can forget it immediately. What matters is what it does. IRMAA is a surcharge, not a replacement for your Medicare premium, an addition on top of it. In 2026, the standard Part B premium, the base rate every Medicare enrollee pays, is $202.90 a month. IRMAA is what Medicare charges on top of that. If your income clears certain thresholds, the two numbers stack. Here's the first thing that surprises most people. Only about 7 to 8% of Medicare beneficiaries pay it. That sounds reassuring until you think about what it actually means. If 7 out of 100 people in your neighborhood are paying this surcharge, the other 93 have never had a reason to mention it. It's never come up at dinner. Your retired neighbor doesn't know about it. Your brother-in-law doesn't know about it. Your doctor doesn't know about it. The silence around IRMAA isn't because it's rare enough to ignore. It's because the people paying it often don't fully understand why, and the people not paying it have never had to find out. And Medicare doesn't advertise it. There's no orientation packet when you enroll that says, by the way, if your income crosses this line 2 years from now, your premium goes up automatically. It's a mechanism built into the system. It runs whether you know it's there or not. 2 things worth clearing up before we go further, because they catch people off guard. First, IRMAA applies to Medicare Advantage plans too. If you're on a Medicare Advantage plan, a Part C plan through a private insurer, and you think that insulates you from this surcharge, it doesn't. IRMAA follows the person, not the plan type. You still owe it. Second, there are actually 2 IRMAA surcharges, one on Part B, your medical coverage, one on Part D, your prescription drug coverage. They're calculated separately and they stack. And here's the part that trips up a lot of retirees, especially those with union benefits or federal retirement coverage. The Part D surcharge is paid directly to Medicare, not to your plan, not to your former employer's benefits office, to Medicare directly. Even if your former employer covers your Part D plan premium entirely, you're still on the hook for the IRMAA surcharge on top of it. And it arrives as a separate bill most people don't recognize when it shows up. Before we go any further, if you're already on Medicare or within a few years of it, drop a comment right now. Did you know IRMAA existed before this video? I'm genuinely curious. Most people I hear from didn't. And if you're watching this with someone who's approaching Medicare age, this is a good moment to share it with them. This is exactly the kind of thing that gets missed until it's too late to plan around it. Now, you know what IRMAA is. You know it's automatic, it's silent, and it applies regardless of your plan type. What you don't know yet is the specific mechanic that makes it so dangerous, and that's the cliff. The cliff. How $1 becomes $1,148. Most people assume that if a surcharge scales with income, it scales gradually. A little more income, a little more surcharge. That's how most graduated systems work. Progressive tax brackets work that way. Standard deduction phase-outs work that way. IRMAA does not work that way. There are 5 income thresholds, 5 lines drawn in the sand, and the rule is the same at every single one of them. Cross it by any amount, $1, 1 cent, and the full surcharge for that tier activates immediately, the entire year. No phase-in, no taper, no partial adjustment because you only went over by a little. The full amount, all at once, the moment you cross the line. That is the cliff. And here's what it costs. For a single filer in 2026, the first threshold sits at $109,000 of modified adjusted gross income. Stay below it, even at $108,999, and you pay 0 IRMAA, 0 surcharge on top of the standard premium. Cross it by $1, and Medicare adds $81.20 per month to your Part B premium, plus $14.50 per month to your Part D premium. That's $95.70 every month. Multiply that by 12, and the first cliff costs you $1,148 a year. $1 of extra income. $1,148 a year. That is the title of this video, and it is not a rounding error. It is the exact, confirmed math. But Tier 1 is just the beginning. Let me walk you through all 5 because the numbers get serious fast. Tier 2 starts at $137,000 for a single filer. Cross that line and the annual surcharge jumps to approximately $2,886 per person. Tier 3 starts at $171,000. Annual cost, approximately $4,619 per person. Tier 4 starts at $205,000. Annual cost, approximately $6,235 per person. And Tier 5, the top, kicks in at $500,000 of MAGI. Annual surcharge, approximately $6,936 per person. If you're married and both spouses are enrolled in Medicare, those numbers double. A married couple where both cross into Tier 1 pays $2,297 a year from a single dollar of excess household income. Both at Tier 5, $13,872 a year. Combined, on top of the standard premium they're already paying. Joint filer thresholds are roughly double the single figures, $218,000 for Tier 1, $274,000 for Tier 2, $342,000 for Tier 3, $410,000 for Tier 4, and $750,000 for Tier 5. Now, one more thing about those top-tier thresholds that doesn't get mentioned enough. The first 4 tiers are adjusted annually for inflation. The Tier 5 threshold, $500,000 for single filers, $750,000 for joint, is frozen. It doesn't move. It's locked through at least 2028, which means inflation is slowly pulling more people toward it every year without the threshold ever rising to meet them. You now know the cliff exists. You know what each drop costs. But here's what most people still don't understand. And this is the part that turns a manageable problem into one you can't fix. The income that triggers IRMAA isn't the income you're earning right now. The 2-year time bomb. Your 2026 Medicare premium is not based on your 2026 income. It's not based on your 2025 income either. It's based on your 2024 tax return, the one you filed last spring. That is the 2-year lookback. Medicare uses your tax return from 2 years prior to calculate your current premium. The IRS sends that data to Social Security. Social Security applies the IRMAA formula, and your premium is set before the calendar year even begins, based on income decisions you made 24 months ago. Think about what that means in practice. Decisions you are making right now in 2026, a Roth conversion, a property sale, a large IRA withdrawal, will not show up in your Medicare premium until 2028, not next year, 2028, 2 full years from now, when the memory of that decision has faded, when you've moved on, when the tax return that captured it feels like ancient history. And here's where the trap closes. Closed tax years cannot be reopened. If your 2024 income pushed you over a threshold, there is nothing you can do in 2026 to change what your 2024 tax return says. The income was earned. It was reported. Medicare has already read it. The surcharge is already set. You are, right now, paying Medicare premiums based on choices you made in 2024, and the choices you make this year will determine what you pay in 2028. That 2-year gap is not a bureaucratic quirk. It is the core reason IRMAA catches so many people completely off guard. There's another layer to this that makes it even easier to miss. If you're receiving Social Security benefits, Medicare doesn't send you a separate IRMAA bill. The surcharge is deducted directly from your Social Security check, quietly, automatically, every month. Your check is simply smaller than you expected, and unless you sit down and calculate exactly what your Part B premium should be, you might not even notice the deduction for months. If you're not yet receiving Social Security, Medicare bills you separately through a form called CMS 500. It arrives by mail. Most retirees don't recognize it. It doesn't say IRMAA surcharge. In large letters across the top, it arrives, it looks like a routine Medicare statement, and it gets set aside, sometimes until the balance has been accumulating for months. Neither delivery method comes with an explanation of why your premium changed. You have to go looking for that answer yourself. So let's put the full picture together before we move forward. IRMAA is a surcharge that activates the moment you cross one of 5 income thresholds, with no phase-in, no warning, and no exception for how close you came to staying under. It's calculated from a tax return that's already 2 years old by the time you feel it, and it arrives either as a quiet reduction in your Social Security check or as a piece of mail most people don't recognize. The question that matters now is, what income events are actually pushing people over these cliffs? Because in most cases, it isn't a sudden windfall. It isn't an inheritance. It's ordinary retirement planning, the kind of moves that sound smart in isolation, landing in the wrong year at the wrong amount. That's what we're covering next. The 4 retirement moves that push people over the cliff. The retirees paying IRMAA surcharges are not, for the most part, people with unusually high incomes. They're people who had a specific financial event in a specific calendar year, a move they made for entirely reasonable reasons. And that event spiked their modified adjusted gross income past a threshold they weren't tracking. Here are the 4 most common triggers, and if any of these situations sound like yours, pay close attention, because the 2-year clock is already running. The first is required minimum distributions. At age 73, the IRS requires you to begin taking withdrawals from your traditional IRA and most employer retirement accounts. Not optional, not deferrable, mandatory, on a schedule the IRS sets based on your account balance and your age. Every dollar you pull out is classified as ordinary income and flows directly into your adjusted gross income, which flows directly into your IRMAA calculation. Here's where it gets compounding. RMDs increase as you age. Your required withdrawal percentage goes up every year. And if your IRA has grown significantly, as many have over the past decade, those distributions can be substantial even if your lifestyle spending is modest. You can live simply, spend carefully, do everything right, and still have an RMD that pushes your MAGI over an IRMAA threshold purely because the math requires it. There's no override. The distribution is mandatory, and the surcharge follows. The second trigger is Roth conversions, and this one is worth pausing on because it's the one that surprises people the most. Converting money from a traditional IRA to a Roth IRA is in many cases a genuinely smart, long-term move. Future Roth distributions are tax-free. They don't count toward your IRMAA AMAGI. Done correctly over time, Roth conversions can significantly reduce your future Medicare exposure. The problem is the year the conversion happens. The amount you convert is added to your adjusted gross income for that calendar year, fully, immediately, as ordinary income. Convert $50,000 in a single year, and your AGI rises by $50,000. Convert $100,000, and it rises by $100,000. If that conversion pushes your MAGI over an IRMAA threshold, you've triggered the surcharge for the premium year 2 years out, and the conversion itself, being voluntary, does not qualify for any kind of appeal or reversal. The move that was supposed to protect you from future Medicare costs created a Medicare cost in the near term. That is the Roth conversion trap, and it catches careful, well-intentioned retirees every year. The third trigger is selling a home or rental property. Capital gains from a property sale hit your MAGI as a one-time spike in the year of the sale. For a rental property held for decades, with a low-cost basis and significant appreciation, that gain can be substantial. A couple with perfectly ordinary annual income might find their MAGI doubled or tripled in the year they sell a property they've been holding since the 90s. Every IRMAA tier they cross in that single year costs them, per person, for the full year, with no acknowledgement that it was a one-time event and not a reflection of their normal financial picture. There is no one-time exception for capital gains. Medicare doesn't distinguish between recurring income and a single transaction. A gain is income. Income is MAGI. MAGI determines the surcharge. The fourth trigger is one that almost no one anticipates: municipal bond interest. Many retirees hold municipal bonds specifically because the interest is federal tax exempt. It doesn't show up in taxable income. It doesn't affect your income tax bill. For decades, that's been the point, a way to generate income that stays invisible to the IRS. It is not invisible to Medicare. IRMAA's definition of modified adjusted gross income is your AGI from Form 1040 line 11 plus your tax-exempt interest from line 2A. That second piece, tax-exempt interest, which includes municipal bond income, is added back in explicitly. Medicare designed MAGI this way on purpose. A retiree holding a significant muni bond portfolio who has carefully managed their taxable income to stay under an IRMAA threshold may still be over that threshold once the bond interest is added back in. And they won't know it until they look at both lines of their tax return together. This is a silent trigger. The income feels invisible. The surcharge is not. A few others worth a brief mention: a pension cost of living adjustment that pushes a borderline filer over a threshold they've been skating just under for years. Inheriting a traditional IRA, where required distributions from the inherited account flow directly into MAGI. These aren't rare edge cases. They're ordinary retirement events that interact with IRMAA in ways most people, and many advisors, don't anticipate. Drop a comment right now. Which of these situations is closest to yours? RMDs you can't control, a Roth conversion you're planning, a property you're thinking about selling, or muni bonds you've been holding for years. I read every comment, and your situation might be worth its own video. Now, before we get to the one exit that actually works, There's a specific scenario buried inside the IRMAA rules that I want to flag. It doesn't apply to everyone, but for the people it does apply to, it's the most expensive surprise in this entire video. The married filing separately trap. Most of what we've covered so far applies to single filers and married couples filing jointly. But there's a third filing status that interacts with IRMAA in a way that's almost punishing. And it applies to people going through some of the hardest life transitions a retiree can face. Married filing separately. Under normal IRMAA rules, joint filers get roughly double the income thresholds of single filers. That makes sense. 2 incomes, 2 people, proportionally scaled. But married filing separately gets no such accommodation. The thresholds collapse. The 5-tier structure compresses into 3 tiers. And at just $109,001 of MAGI, the same dollar amount that pushes a single filer into Tier 1, a married filing separately filer jumps almost immediately into a surcharge equivalent to Tier 4 on the standard scale. Read that again. $1 over $109,000, and you're not paying Tier 1 surcharges, you're paying near the top of the entire structure. This matters because married filing separately isn't a filing status people choose for convenience. It's usually the result of a life event, a divorce, a legal separation, a situation where spouses have incompatible tax circumstances that make joint filing impractical or harmful. People filing separately are often already navigating something difficult, and then, on top of whatever brought them to that filing status, IRMAA delivers a compressed bracket structure that can add thousands of dollars per year to their Medicare bill. The combination is what makes it so dangerous. A divorce finalizes, filing status changes. And if the income picture shifted in that same year, as it often does during a separation, with property settlements, retirement account divisions, or changes in pension income, both the filing status and the income event hit the IRMAA calculation simultaneously. The result can be a surcharge far larger than either factor would have produced on its own. If you're approaching a divorce, a separation, or any situation that might change your filing status, this is a conversation to have with your tax advisor before the year closes, not after. Once the tax year ends and the return is filed, the IRMAA calculation is already locked. This beat is short because the rule itself is straightforward. But for the people it applies to, it's worth more than the time it takes to explain it. Now let's talk about the exit. The one exit that works and the 2 that don't. By now, you understand the mechanism. You understand the cliff, the 2-year lookback, the triggers, and the filing status trap. So the natural question is, if you've already been hit with an IRMAA surcharge, is there any way to reverse it? The answer is yes, but only under specific conditions. And understanding exactly which conditions qualify and which don't is the difference between filing a successful appeal and spending months on paperwork that Medicare will deny. The legal mechanism is called Form SSA 44. It's a life-changing event appeal, filed directly with Social Security. If a qualifying life event caused your income to drop significantly from the year Medicare is using to calculate your premium, you can request that Medicare use a more recent year's income instead. If approved, your surcharge is recalculated based on that lower income, and in some cases, eliminated entirely. There are 8 qualifying events: retirement or work stoppage, a reduction in work hours, marriage, divorce or annulment, death of a spouse, loss of pension income, loss of income-producing property through no fault of your own, a natural disaster, for example, or a condemnation, and receipt of an employer settlement payment, such as a severance, that inflated income in the look-back year but won't recur. If one of those events applies to you, you have 60 days from the date on your IRMAA determination letter to file the appeal. Not 60 days from when you open the letter. 60 days from the date printed on it. Documentation matters. Social Security will want proof of the qualifying event and proof of your current income level. The appeal that gets approved quickly is almost always the one that arrives complete, organized, and clearly tied to a specific qualifying event. Now here's the part that matters just as much as knowing what qualifies, knowing what doesn't. A Roth conversion does not qualify for SSA 44. It's voluntary income. You chose to convert, you chose the amount, you chose the year. Medicare treats voluntary income decisions as outside the scope of a life-changing event appeal, and Social Security will deny the claim. Selling a rental property does not qualify. Also, voluntary. You decided to sell, you set the timeline. The gain was the result of a deliberate transaction, not a qualifying event. In both cases, the Roth conversion and the property sale, the surcharge stands. There is no appeal path. The only protection against those triggers is forward planning, before the income event happens, not after. This is worth sitting with for a moment. The two most common IRMAA triggers among people doing active retirement planning, Roth conversions and property sales, are also the two that offer zero recourse after the fact. If you're planning either of those moves, the time to account for IRMAA is before you execute, not when the premium notice arrives 2 years later. Roughly half of all SSA 44 appeals are delayed or denied, not because people don't have qualifying events, but because the documentation is incomplete, the timing is off, or the event doesn't meet the specific definition Medicare applies. If you're filing, file carefully, file complete, and file within that 60-day window. So let me leave you with 3 things you can actually do with what you've learned today. First, know your MAGI, not your taxable income, not your gross income, your modified adjusted gross income, AGI from line 11 of your Form 1040, plus tax-exempt interest from line 2A. Those two numbers added together are what Medicare sees. If you don't know that combined figure for your most recent tax year, look it up this week. It takes about 3 minutes with a copy of your return in front of you. Second, plan income-generating events with the brackets in mind. If you're considering a Roth conversion, a property sale, or a significant IRA withdrawal, run the MAGI math before you execute. A conversion staged across 2 or 3 years instead of 1 can be the difference between 0 IRMAA and $4,600 a year in surcharges. The brackets are public, the thresholds are known. Planning around them is entirely legal and entirely reasonable. Third, if a qualifying life event has reduced your income, file SSA 44 within 60 days of your determination letter. Don't wait. Don't assume Medicare will catch up on its own. The appeal process exists specifically for this situation, but it only works if you use it and only within the window. The system runs automatically. It doesn't pause to ask whether you knew the rule. It doesn't offer a grace period for people who found out too late. What it does offer, to the people who understand it, is a 2-year runway. Decisions made today, in 2026, set your 2028 premium. That runway is open right now. The question is whether you use it. This is the $1 rule. $1 over a threshold you didn't know existed, calculated from income 2 years ago, arriving as a bill you didn't see coming. The mechanism is automatic, it's legal, and it runs whether you're watching it or not. But you're watching it now. And that changes what the next 2 years look like. If this video helped you see something you hadn't seen before, share it with someone who's approaching Medicare or already on it. A spouse, a sibling, a friend who's been talking about a Roth conversion or a property sale. This is exactly the kind of thing that gets missed until the window is already closed. Subscribe if you want to keep getting this kind of briefing. No noise, just the rules that actually affect what you keep in retirement. And drop a comment before you go. Which of the 4 triggers is closest to your situation right now? I read them all. A reminder that nothing in this video is personal financial or tax advice. Always work with a qualified professional who knows your full picture. But now, you know the right questions to bring to that conversation. I'll see you in the next one.